Everything you've been told about 2026 tax cliff is completely wrong. While the media was panicking about the old tax cuts expiring, a massive new law just rewrote the rules for every business owner in America. If you are still planning your taxes based on last year's advice, you aren't just behind. You are actively overpaying the IRS by 5 to 6 figures. I'm Henok Kebede. I'm a licensed certified public accountant and founder of HK Financial Advisory. We specialize in advanced tax optimization for high-income entrepreneurs and business owners. We don't just put numbers in boxes on April 15. We engineer proactive tax strategies that help our clients keep millions of dollars in their own pockets. So today, I'm breaking down 5 most expensive mistakes business owners are making right now under the new 2026 tax codes. You're gonna learn exactly how the rules around your 20% business deduction just changed. I'll show you why the dreaded alternative minimum tax is about to blindside high earners this year. And I'll reveal exactly how the new $40,000 SALT deduction cap actually works. If you want to protect your profit and stop funding the government's next spending bill, stay with me until the end. Let's jump right into the first major trap, which involves a massive deduction most people thought was dead. Mistake number 1 is abandoning the 20% QBI deduction. For years, everyone warned that the Section 199A qualified business income deduction would vanish in 2026. Most people don't realize the One Big Beautiful Bill Act permanently extended it. And starting in 2026, they even added a brand new minimum deduction of $400 for anyone with at least $1,000 in active business income. So if your accountant is telling you the 20% pass-through deduction is gone, fire them today. This applies to pass-through entity owners like S-Corps and partnerships and sole proprietors. But here's the mistake you absolutely must avoid. The biggest trap here is poor salary optimization. So if you pay yourself too much in W-2 wages, you actually reduce the net profit that is eligible for that 20% deduction. You must project your QBI and set your optimized W-2 salary before running your final payroll in December. Mistake number 2 is ignoring the new $40,000 SALT cap. Since 2018, the state and local tax deduction, also known as SALT, has been aggressively capped at $10,000. So this was an absolute nightmare for business owners living in high tax states like California, New York, or New Jersey. Here's where people mess this up. They assume the $10,000 cap is still the law of the land. It is not. For 2026, the SALT deduction cap has skyrocketed to $40,000 for taxpayers making under $500,000. So if you pay $35,000 a year in property taxes and state income taxes, you used to just lose $25,000 of that deduction. Now, under the 2026 limits, you can deduct that entire $35,000 on your Schedule A. But watch out for the new income phase-out trap. This expanded $40,000 cap starts phasing down at strict 30% rate once your modified adjusted gross income crosses $500,000. So if your income gets too high, your cap crashes right back to $10,000. This is exactly why we help our clients closely manage the timing of their income and distributions. Mistake number 3 is getting blindsided by the AMT expansion. The alternative minimum tax, or AMT, is a shadow tax system. It is designed to ensure wealthy people can't use too many deductions to zero out their tax bill. Over the last few years, the AMT exemption thresholds were so high that most business owners never had to worry about it. But for 2026, the new legislation reset the threshold for married couples to start losing their AMT exemption down to $1 million. So imagine a successful business owner who decides to sell a piece of real estate or execute a large Roth conversion this year. Their income suddenly spikes to $1.2 million. Because they crossed that $1 million threshold, they will rapidly lose their AMT exemption. They will suddenly face a punishing, surprise tax bill they never budgeted for. You must avoid triggering massive capital gains or exercising incentive stock options without running an AMT projection first. You need a mid-year tax projection by July 2026 to see if you are tracking toward the AMT danger zone.
Sometimes just to wake up the world, I've got to get.
Mistake number 4 is missing the permanent return of 100% bonus depreciation. See, under the old laws, bonus depreciation was phasing out and was supposed to drop to 20% by 2026. But the new legislation completely reversed this. It established 100% bonus depreciation permanently for business investments in machinery, equipment, and short-lived assets. So let's say you buy a $150,000 piece of heavy equipment for your business this year. So instead of spreading that deduction out over several years, you can write off the entire $150,000 immediately. This is a massive cash flow advantage for business owners who are expanding. Just remember, the asset must be placed in service before December 31st to take the deduction this year.
Something's gotta hit it right on the nose.
Mistake number 5 is misunderstanding the new standard deduction and charitable giving rules. See, the standard deduction just saw a huge bump this year, sitting at over $31,500 for married couples filing jointly. Because it's so high, most business owners won't itemize their deductions. But here's where they mess up. Starting in 2026, the new law created a special above-the-line deduction for charitable contributions if you do not itemize. It equals to $1,000 for single taxpayers and $2,000 for married couples. So if you take the standard deduction and forget to claim this new $2,000 charitable write-off, you are literally leaving money on the table. So make sure you're tracking your charitable giving, even if you don't plan to itemize your taxes this year.
So if you really get exactly what I meant, I must.
Before we wrap up, here is a bonus strategy. And this one is a powerful new tool for employee retention. So starting right now, employers can contribute up to $2,500 per year toward an eligible employees or dependents Trump account. And here's the best part. It does not count as taxable income for the employee. If you're a high income earner with a team, you should be utilizing these accounts to boost employee compensation entirely tax-free. This is something we implement for clients constantly to maximize benefits and lower overall tax burdens. See, the 2026 tax landscape is completely different from what we had just a few months ago. If you wait until April to talk to your CPA, it's already too late. Tax filing is looking in the rearview mirror. Tax strategy is looking at the road ahead so you don't dive off of a cliff. Right now, my team at HK Financial Advisory is opening up a few spots for strategy sessions. We are helping high-income business owners implement these exact 2026 changes before the December 31st deadline passes. Click the link in the description or the pinned comment below to book a call with us today. Let's make sure you keep your wealth instead of handing it over to the IRS. This video was helpful. Hit the like button. Share it with your friends so they can benefit from it too. See you on the next video.
I can love you forever.